Danielle Arlowe. Good morning. You look excited.
So excited. Mr. Chair and members of the committee, I'm Danielle Fagre Arlowe, Senior Vice President of the American Financial Services Association. Our association is 100 years old. We represent everything from traditional installment lenders to vehicle finance companies to mortgage lenders to credit card companies. We have everyone from one-state operators to the world's largest banks as members. We do not represent payday lenders. We do not represent title lenders. We do not represent credit unions. S518 would limit APR to 36% using the so-called military APR calculation created under the Military Lending Act. But the Military Lending Act isn't working for the military. The Urban Institute did a comprehensive study looking at 8 years of credit bureau data under the Military Lending Act. They found no decrease in collection rates, no increase in credit scores, that subprime military members had much less access to credit, and they noted that extending the Military Lending Act would likely have more detrimental effects on the most vulnerable members of society. Why would we expand something that isn't even working for the people that it was designed to help? And you might ask, who is the Urban Institute who did this study? The Urban Institute is a nonprofit research group that focuses on upward mobility and equality. It was founded by President Lyndon Johnson in the 1960s. This isn't some industry shill group. Second, S518 would have South Carolina follow in Illinois' footsteps. We know 3 things about Illinois since the state passed their law. 1, 368,916 lost people. That's the total number of borrowers who are no longer getting a state-regulated and state-reported loan product at all. Where did these people go? Nobody knows, because credit unions don't even report that category of data. But that number that we got, that I just gave you, is from the state of Illinois' own data in their trends report. Second, we know there's been a significant decrease in credit availability. A recent independent study by a group of economists, which has been referenced earlier today, found that since the law went into effect, it has decreased the number of loans to subprime borrowers by 44% and increased the average loan size by 40%. The economists concluded that the Illinois law, and I quote, significantly decreased the availability of small dollar credit, particularly to subprime borrowers, and undermined the financial well-being of many, many consumers. Third, for the lucky people who are still getting loans in Illinois, they're getting larger loans over longer terms. And I think that one thing that Mr. Waters said bears repeating. Throughout this hearing, when there's been mention of 66% rate cap, 66% APR, or 80% APR, there's been an audible gasp in the room. And I think that the gasp shows how misleading APR is. So the example that he gave is, say you lend me $100 and you charge me $1 interest. Sounds like a great deal. I think everyone can agree to that. If I pay you back in a year, it's 1% APR. If I pay you back tomorrow, it's 365% APR. If I pay you back in an hour, it's 8,760% APR. The gasp is related to time and not cost. The cost is $1. The interest is $1. The APR in an hour is over 8,000%. There's been some discussion in the hearing 2 weeks ago and today, the idea that the banks are going to step in. The idea that banks and credit unions can pick up the slack from established licensed non-bank lenders is a pipe dream. I love banks. My background is in banking. We have lots of banks as members, but banks are not in the business of making very small dollar loans. And we're not aware of any banks in the business of making a very small dollar loan at 36% that isn't either subsidized or tied to an account or made under some special subsidized program.
Senator from Richland has a question for you.
Oh, yes, sorry.
Thank you so much. So prior to the title loans and the other companies charging the big percentage rate, there were still people getting loans because there were little small loan shops on Main Street in Columbia and other locations who were lending money to $500 to $250, whatever they had. You said if they close, there won't be anybody. Trust me, this group was the group to put the other group out of business. And he also mentioned about the veterans.
I'm sorry, I don't understand the question.
Well, the question is, now I'm going back to a statement you made.
Uh-huh.
If they go away, there won't be anybody to take care of that lending practice. Trust me, there will be.
You're saying that if we put a 36% rate cap, there'll be all kinds of people who want to get into the business?
Well, you just had earlier, you had Fidelity, a Garden Fidelity company who says, we have a high of 49, but our average is 36.
Uh-huh.
Who's been doing it for 30 years?
Well, and those are subsidized loans, and that's true. If the government wants to pay for loans, we could give 0% loans to everybody forever. But for people who have to make a profit, or if we're not going to subsidize it from government, it's a unicorn. You can't. The Federal Reserve itself says you cannot make a loan. You can't break even under $2,500. The Federal Reserve says that.
So you also mentioned about the military. What percentage of the military falls in that category below the federal poverty guideline?
Well, I don't know. We should ask someone from there.
Let me help you with it.
Okay.
It's about 4.5%. The E4s or less is about 42,000, which is 3.5% that falls below the poverty guideline. Our armed forces is much, much larger. 11.6 it makes up the total American population. And so on one hand, while the federal government gives them the protection of the 36%, which it doesn't fit everybody, and we notice in the 11.6, it probably doesn't fit everybody, there will always be market for lending and for borrowing. And so when I hear a statement like that, and I know you know, it's like all statistical data that you gather, depending upon who wrote it at the time that it was written. So I'm trying to figure out there's 3.5% of those E4s, and it referenced it in the information. How many of those E4s are actually borrowing that money, and you got the data, who are not able to pay the mortgage back? I'm going to start on the poverty guideline. Are these other folk outside the poverty guideline just doing poor management of money?
Let me be clear about what information I have. I have a study that was done over the period of 8 years looking at interest rates, looking at the military from the Urban Institute, a nonprofit group that studies upward mobility and was founded by President Johnson. So I'm not an expert on which members of the military are getting what loans, but I do know one thing from that study, and that is, sure, you can make loans at 36% military APR, but the loans are going to be much larger than what most people need, and be paid over a much longer period of time, and ultimately are going to be a lot more dollars that they're paying than, even though the APR is lower, the cost is going to be higher. And there is a market for that. I agree with you.
So that market is controlled by those companies in terms of what the independent product is. Like you see, you've been in the mortgage business a long time. The company themselves, if it's a product that they keep a sub-portfolio in-house, a product they're selling into the market. But that company makes that decision. And most of these products are in-house portfolio products they're selling. So they control whether or not that loan is going to be smaller or going to be larger. Thank you.
Yeah, and if you're regulated, I mean, if you're a bank and you're federally regulated, you're not allowed to make risky loans. You're not allowed to make loans at a certain level of risk.
Senator from Charleston.
Yes.
Hi.
Thank you. Hi. Bankers talk really fast, so I need to ask you to back up. You said something about somebody said, or some entity said, you can't break even under a $2,500 loan.
Yes, I'm so glad you asked that. It was the United States Federal Reserve.
Okay, so not just some study.
Not some fly-by-night, not some personally interested individual.
Well, some would argue right now whether the Federal Reserve is fly-by-night.
Okay. There was also mention made, I believe, in the testimony 2 weeks ago that was provided, that there's this, big trend towards 36% all-in rate caps. And since we're a national organization, I have a little map here. I can leave it with you. There are only 4 states where our members, and we don't represent the payday lending industry, but where our members are subject to 36%, what we call all-in rate caps. Those are Connecticut, where the rate is about 17 or 18%, and most of our members are not doing business there at all. The ones that are doing very large loans over very long periods of time. South Dakota, which has too few of, just doesn't have a lot of people, frankly. New Mexico, which their law just went into effect January 1st of this year, so, a couple months ago, 2 months ago today. And then Illinois, which is a complete unmitigated disaster. That's where we are. And I guess I'd end by saying, don't take it from me. Take it from Illinois' own data. Take it from the independent economists who studied the law in Illinois and just came out with a study. Take it from the United States Federal Reserve, who said you can't break even until 2,500. Take it from the Urban Institute, created to study upward mobility in the 60s by President Johnson. Take it from the National Black Caucus of State Legislators, who came out with a policy resolution that says that they believe there's a role for the expansion of traditional installment loans as an affordable means for borrowers to establish credit and secure small dollar closed-end credit while preventing the cycle of debt issues inherent with non-amortizing balloon payment loans. And take it from the Congressional Black Caucus Foundation, which said, this is really good. I hope I don't lose it here. Sorry. They did a report last year that highlighted the harm of 36% rate caps, saying that proposals to protect consumers from predatory practices through a 36% cap cause more harm than good by limiting access to credit. That's the Congressional Black Caucus Foundation. S518 is not what it purports to be, and it will not be good for South Carolina. Thank you so much.
All right, thank you very much. Folks, we are about the end of our allotted time, and a number of members, including myself, have another committee meeting to get to at 11 o'clock. So we're going to have to end that there. We do have a few more speakers that wanted to speak today. We will we'll reschedule and hear from them. I would like, if the committee will